During the luncheon break, somebody said that my face was familiar. Well, it is. I'm quite old, so I've been around a long time. But this person apparently had seen me on television, and that was a few years back, and it wasn't anything to do with my profession. It was that my wife and I got suckered into doing a Duncan Hines cake commercial. Anyway, shortly after I'd done this cake commercial, I was talking at the tax course for CICA, and we were being introduced by the chairman, and he said the gentleman on my immediate right is a lawyer, and he's so-and-so. She's Jim Ware from Oslo-Hoskin, was what he said. He said, the gentleman on my far right, his face will be familiar to those of you who've seen the Duncan Hines cake commercial. Well, half the people reacted, and the rest hadn't seen it. So Jim, the lawyer, who has to explain everything, gets up and he says, those of you who haven't seen this cake commercial, what's happened is Bill's wife's cooked these two cakes. One of them is her own scratch cake, and one is a Duncan Hines cake. And Bill tastes a little bit of the scratch cake, and then he tastes a little bit of the cake commercial, the Duncan Hines cake, and the voice at the back says, he looks like he ate the whole thing. Been trying to lose weight ever since. We had a mess up with the audio stuff. We had a mess up with the visual stuff, but we've got something that I hope you can see. Not much better than it was before, but at least you can see the numbers up there, and I think you'll know what page I'm talking about as I go through this. Okay, what I left you with immediately before lunch was talking about underlying assets and saying, okay, if somebody is buying those assets, they're going to buy those assets at a certain value. This is all a plan so that you can all go to sleep so that I don't know it's happening. Then we looked at the liquidation value and what in reality would happen if you had to dispose of those assets, albeit in an orderly fashion. What is a reasonable amount for the individual shareholders to get out? Now, that's not so important for the individual shareholders who are selling the property as those who are buying it. And I think the importance of that I'll demonstrate as I go on talking through the afternoon. If you want me to stop and explain something, it might be too awkward if you do it too often. If you can't hear what I'm saying, just let me know. Okay, and we're going to have a little question period just at logical breaking points, and if you're too bored, I'll do something with an acetate or something. Okay. The next area I'm going to talk about is the capitalization of earnings, and this is the traditional method of valuing a business, a going concern business. If you want to buy a business, you look and see what sort of capitalization of the earnings, what amount you might pay. What you're really looking at is saying, what sort of a yield am I going to get from that business? How much am I prepared to pay to get that yield? Like, if you can put money in Canada savings bonds and get 12%, you're not likely to go and buy a company that's going to yield you 7%. Unless you're on a big ego trip and want to be president of something. So you're going to want to get something better than that because you're putting the money at risk. And that is, so you've got to determine what those earnings are. And if the earnings are $20,000 a year, you say, well, geez, I can pay 5 times that. I would be prepared to get 20%. I'll pay $100,000 for that business. And over the last little while, there have been a number of businesses that have exchanged hands for much better ratios than that. And I was involved in one the other day that worked out very well, thank goodness. I was supposed to look at the value. I couldn't believe it. The guy was going to get his money back in a year based on all the figures that I had, and he got his money back in 6 months, and the bonus was that he paid my fee. Anyway, looking now at, what do we do here? It's all a big plot, right? Make the accountant look silly in front of the lawyers. Anybody know how to fix it? No, good. We'll have to scrap about 4 stories now. Or maybe in the coffee break we'll get it straightened out. Okay, so we're back to looking at the hard copy you've got. We may as well have the lights on. Maybe as well everybody should be awake. Is there another switch or something? Oh, what the hell? Okay, let's look at the capitalization of earnings. We're back to Val 11. What you're trying to do is you're trying to normalize the reported operating results. You try and find out what normally those earnings would be. I think you all appreciate that some people take huge, great bonuses out. Guy owns a company, it makes $1 million. He says, wait a minute, 200,000 I get the low rate on. The top 800,000 I'm going to pay 51% in the corporation. And then I've still got to get the money out and pay a tax on the dividend. I may as well take the money out and have it as a bonus and do some playing around with deferring the payment of the taxes, and the corporation doesn't have to pay installments, and I'll do my forward average refundable tax bit and all those things. And he sees that he's paid himself out a big bonus. When he comes to value the company, he says, wait a minute, it's not only making $200,000 a year, it's making $1 million a year. And so that's what the normalizing of the reported earnings is. So you add back unreasonable salaries, or you deduct salaries if the client has been going on a dividend basis, that he prefers dividends to salaries. You adjust for non-recurring income or expense items, fortuitous sales. I don't think I'm ever going to be invited back here again. There seems to be trouble when I get up here. Amortization of goodwill. Quite often when you buy a business, you say, hey, the assets are worth something, but these guys have got something, a name, that is really worth something. It's not a hard asset, but you pay for that goodwill, and under generally accepted accounting principles, I think it has to be amortized over 20 years, right? At 40 years. After tax, it's 20 years. Nothing to do with tax. You don't get a deduction for it, but you have to amortize it over at least 40 years, the goodwill that you purchase, so that gets added back in determining what the normalized earnings might be. Then the next step would be to deduct the income from redundant assets, and that's the net redundant assets, and I'll look at that in a minute. I'll look at what redundant assets are in a minute. But you deduct the income from that, because that is not the operating, that's not the business income that you're looking for. You can buy some bonds anytime you like if you've got the money. And that doesn't increase the value of a business. In fact, it might deflate it if you happen to have shares that weren't paying any, and just paying a very nominal dividend. So you would take that income out, and then you would estimate what really are the representative earnings. And this is done on a number of bases. You might say, take the simple average for the last 3 years. This is a business that's always going to be around. Its earnings are representative for all those years. Some years it's gone down, some years it's gone up. Sometime I know that somebody's clawed forward a couple of expenses from the future year into the current year, so the average would be the way to do it. Other times you might say this company is improving, its profitability is really going up, so we'd give more weight to the most recent years, and that's when you do a weighted average. There's an example in your material of the weighted average, and now I knew I was going to say that and not be able to find it. Look on page 90. That's doing a weighted average basis, so you give a value of 1 to the 1980 year and a value of 4 to the 1983 taxation year. And so you do your weighted average. Total makes 10, you average by 10 at the end of it, and you've got the right value. Other situations, and this might be the appropriate value in this case, you might say, well, we just, like 1980, that was the first year of this business. That was really a sort of a startup year. So that's not a meaningful year. We'll cut that one out. 1981, well, maybe that's representative 1982 and 83. So you might just take the last 3 years. So you would cull out the one that doesn't look very representative. Or you might say, this is a relatively new business. We know what it's going to do in future because of the kind of industry it's in. It's in high tech. We're going to be able to do things in future, and then you forecast. The forecasting is the toughest one of the lot. Having done that, you select at what's called a capitalization rate. So you take your earnings, and in my example that I gave you earlier, I said if your earnings are $20,000, your capitalization rate would be 5 times that. Okay, so you multiply, it's basically your multiple. So you multiply by 5 to get the value of the company. then because you have redundant assets, even though you've taken out the income, those redundant assets are there, they can be converted into cash. You would add that back, and then you compute what's called the rateable value of each share, which is basically you divide the number of common shares into the total. Now don't get worried if I leave you in this, because we'll go back and look at a numerical example. Then you might, if you're not very sure of that, you might say, well, what other basis can I go on? Let me look and see whether that's supported by assets underneath, or maybe I should look at discounted cash flows. This company is going to require a lot of capital at some future time. Maybe that changes the value a little bit, or maybe that changes the multiple. Or you look at the underlying redundant assets, and that might change your multiple. You say, geez, I can afford to pay a little bit more for this. So you would look at one or two other methods of determining what the appropriate value is. So don't just accept your accountant's multiple of earnings basis first time round. Then to those, obviously not everybody's going to own 100% of a company. They may own 10% or they may own 90%. And the question is whether you apply a control premium to the fact that you own 90%, or whether you should take a minority discount for the fact that you only own 10%. I mean, if somebody else can vote the board and tell you what to do and pay a dividend when they want, obviously your shares might not be worth as much as the guy who owns 90%. Anyway, I'm going to look at those in a few minutes, those concepts of control premiums and discounts. But I first of all like to just look at the redundant assets, which is on your next overhead, your next hard copy, and the amount is computed, the redundant assets are computed on page 92 if you want to check back to what we originally had. Okay? These redundant assets are those that are not essential to the basic business activity. They might have value, they're just not essential to the basic business activity. They're not essential to P Trading's activities. They could be there or they could not be there. They just happen to be money that is being set aside because he thought, well, maybe I'll buy some land out of before personal tax dollars, or some investments out of before personal tax dollars. Or he may just keep some extra cash sitting there in case he wants to buy a yacht in the company. So the types of non-essential or redundant assets would be excess cash, that beyond what the company really requires for its ongoing. Usually that should be in the form of term deposits or something. A securities portfolio, excess fixed assets, and this isn't only real estate, but it's usually real estate that isn't being used. Investments in other businesses, maybe unrelated businesses that are not consolidated, but substantial investments nonetheless. Unused licenses, franchises, patents, and those sort of things that sit on the balance sheet and maybe have some intrinsic value but are not being presently used for whatever reasons. That you can't use them because somebody else is taking you to court, so you've been told you can't use them for a while. And then various other underutilized assets, they would be redundant assets which are not essential. Now, the net redundant asset, and that's usually what you talk about when you carve out an amount, is the realizable value of redundant assets less any disposal costs, which would basically be your income tax, your commissions that you might pay to somebody else. So that's the net redundant assets, because what you're trying to do is convert those into the cash equivalent of what they might be. If you're valuing a company, you might not like those particular investments. You want to know what is going to be left by the time you finish playing around with the company. Okay, the toughest thing, and the toughest thing in all of these valuations, is determining what should be a capitalization rate. You might look at the general economic conditions and the interest rates, and you might say, hey, I can get 20%, which you could a couple of years ago. I can get 20% with a bank, and it's safe. So a 5 times multiple is the very maximum that I should apply. I should probably apply something lower than that, maybe 4 times even. That's partly determined by what the interest rate is. So that would be one thing, but I'd like to stress that it's only one. You might look at the political and social environment. If you have a contract with the government, companies probably, especially if it's a long-term contract, it might be worth something. Look at the nature of the business and the specific market conditions, and if valuators come in and start doing this, they do quite a lot of work in that particular area. They say what is likely to happen in this particular area, what are the market conditions. If we're into plastics, is there something that is stronger, more durable, cheaper than plastic coming along? And there might well be. So that sort of condition would determine what kind of a factor you might use. You might say, well, I'm going to have it's a 3-year return, that kind of thing. Lou talked about that earlier. Maybe if you're going to get a 3-year return, your building is going to disappear in 3 years, then you're going to use a much lower multiple than you are if you think you've got something that's going to last for a long, long time.
Bill, the valuations we do are really the theoretical valuations. They're not the market valuations.
Yeah.
Hot companies right now are trading at 100 times earnings. The average high-tech company on the TSE is, 20 to 1, I think, right now. Yeah. We're not talking about that type of valuation.
Yeah, those markets, if anybody missed what Lou said, is that lots of companies trade at 100 times earnings. What that really means is that those are the historical earnings you're looking at on one side, and the people who are buying are saying, geez, this thing can really take off, so I'll pay a whole lot more. They're not looking at the current earnings at all. What I'm really looking at here is a basis for valuing companies that A wants to sell it to his kids, or A is divorced and his wife wants a piece of it and wants to determine what the value is. So looking at it completely objectively, what somebody who isn't, I'm going to talk a little bit about synergies in a minute. Synergy is basically that an individual can go out and buy a company and might want to buy it because it fits in very well with what he does. If you say that if we're talking about earnings and just going on historical earnings, that's very misleading, and that's why I say you might look at what the maintainable earnings are. We're looking at the historical earnings only as an indication of what that company might do in the future. And if there are no historical earnings that will give you some idea of what that company might do in the future, then you don't use them. The historical earnings then become meaningless, and you try and go on some other basis. And that's what some of these other things that we'll look at in a moment. I don't think you can dismiss what we're saying about capitalization of earnings, because some companies do in fact trade at 100 times. That those two might just be facts. The basis for the trading of 100 times, or the basis for the trading value, is probably something completely different, which might be projected earnings, discounted future cash flow, or one of those other concepts that I'll talk about in a minute. Anyway, the nature of the business and the specific business market conditions, I think, is a very, very important one. Potential for growth is another one. If a company has been maintaining its earnings, and we know we've had a 10% rate of inflation or a 12% rate of inflation, that company is not worth what it might otherwise be. Company at least has to maintain an inflation growth and something else, and you want to look at that something else. That might help you determine what your multiple might be. And when I come back in a little while and look at the capitalization bases, a couple of bases for doing this, you'll see that I've come with a very ridiculous figure, or if you've read through the material, I've come with a ridiculous figure on the dual capitalization basis. And the reason for that is the projections are obviously a bit out. Anyway, the other thing that you would look at, and I think this is important, is the second line management. This is really important if you're buying a company and the older shareholders, let's say, are getting out of it. The top line guys are getting out, but what you're inheriting is a lot of second line guys. You've got to look and see how important they are, how strong they are. Just yesterday I had a meeting with the guys coming up from the States to be, he was a controller of a company down there, and he's come up to be the manager up here. And I don't feel very confident for that company that they couldn't find a manager up here who knew something about the business to run that, a general manager to run that business up here. I imagine what happened, I don't know all the facts, is they bought the company, the top guys are gone, and they looked through and found there was nobody to run the company. I think that they may have got it at a good deal. Maybe that's why they bought it. Having determined these, maybe your capitalization rate, then you might adjust that rate either up or down for two concepts, two amounts that are measurable. Like, you know, this is an art form as well, but I think it's sort of like Kierkegaard's leap. Those of you familiar with that concept, Kierkegaard thought that you could rationalize yourself up to understanding God, but in due course you had to take a leap, like leaping off the top of a mountain and hoping that you hung on to something that was meaningful. That's really what valuations is. You do it as mathematically accurately as you can, but ultimately there are a couple of things that you have to guess at, hope are right. And so I've gone through the mechanics a bit here of looking at the assets. Now we're getting to something a little bit more nebulous, which is what sort of multiple, whether you go high or low in that multiple range, will depend on certain things. And one is what's called the going concern risk, and the other's called the absolute risk. Let's look at those. On valuation 14, what we're trying to do is do a quantitative assessment of the risk. And the going concern value, if you look at page 96, which is, I jumped ahead a little bit, but going concern value on page 96, we've said, this is for the common shares at the moment, I'm just looking at the common shares, that going concern value could be anywhere between $250,000 and $310,000 for the common shares on a going concern basis. From Appendix 9, I've got this other figure. It doesn't really matter where I got it from, but this is the identifiable tangible asset backing. Those are tangible assets, not goodwill, but that one particular figure. So I've got a figure of $302,000 there. Okay? And I can say, look, we've got a going concern value that we've computed at about $310,000. That's at the high end of the range. And we've got identifiable assets underneath of $302,000. So those are assets that if they're used in their present form should be able to make me some money. It isn't all goodwill sitting underneath there. So my going concern risk is not all goodwill. I've got tangible assets there, and I should be able to make money off those tangible assets in that business. Your next calculation then is, what is your absolute risk? And obviously what's absolutely at risk is what you've paid less what you would get back on a liquidation. And just before lunch I did that liquidation calculation, and that came to an amount of about $164,000. It's on page 86 and it's on Val 10. I don't think we need to look at that. You'll recall that I went through the calculation saying basically you take your assets, you sell them, there are certain costs of winding up, there are certain commission costs, there are certain tax costs. That is your absolute risk. Now, if your absolute risk is the same amount as your going concern value by any good chance, then you've got very little at risk, and you can probably go to a higher multiple. Here it's a little less than half, and you might begin to be a little concerned if you feel that you're in a business where you don't know if you can continue operating. So you want to see what your absolute risk might be. Situation I looked at, there was no absolute risk at all. The guy wound up his business the next day and he got all his money back, and it was a good thing. Anyway, so that's sort of doing a multiple of earnings. I've taken in the example here, I think I'll come back to it in a minute, actually. I'll come back to it. But when I did this calculation, if you want to look at the previous page, I said, we're looking at a 6 times multiple or a 4 times multiple. That's the high and low end of the scale. So on page 95 I'm looking at in your material. And the 6 times multiple implies an interest rate, if you like, of 16.67, and a 4 times implies 22.22. I'm not quite sure why it's that. It might be 4 1/4. I might have used 4 1/2. Should have been 4 1/2. You'll see at the bottom of page 94 that the amount is 4 1/2. So 4 1/2 converts to a deemed interest rate of 22.22%. Okay, what are the advantages of using this kind of valuation over, let's say, looking at the underlying assets, determining what the net asset values are? Well, first of all, it's the most commonly used method, and it's one that you should try and apply if it's reasonable. The problem is, one of the problems is getting at what is a reasonable, maintainable earning level. If you have a good record, the business is not really impacted greatly by changes, then you can probably use historical earnings to project future earnings. People will generally accept this basis. Most calculations are just look only at this kind of a thing, and it uses firm historical data. Those are the advantages of it. You base all your calculations, on historical data. The disadvantage is that it doesn't consider cash flows, and I said a little earlier that cash is what's important. Cash is what's important to most people. So it ignores cash flow generally, because what it does is it looks at, quotes, earnings on the accounting basis, earnings on lose basis, with all those taxes that these businesses should have paid and didn't pay. No, that's not quite right, but it does ignore those kind of things. It ignores depreciation and that one company, Company A, might be claiming much more depreciation than Company B, either because it has a higher cost of assets or is more capital intensive, or because the assets are newer, or because management thinks that the property should be depreciated over a shorter term. All of those things will impact. Or because one company rents a building and the other owns it. All of those things ignore cash flow and look only at profit. And if you're basing your capitalization of earnings only on the profit, the historical profit, what you're really doing is ignoring cash flow. So that's one of the problems with just a straight multiple of earnings, looking at future earnings in isolation. And the biggest problems I keep harping on this, is that some judgment is required in the determination of the capitalization rate. Okay. Just going back and looking at a calculation for P trading, what we might think is a reasonable capitalization. Looking at Val 6, and that's on Appendix 6, which is page 90. That's where this calculation comes from. You don't need to flip back to it particularly, because it's a bit mechanical. But taking the top line of the Val 6, we see that the normalized operating results, we've normalized them 29,000, 42,000, 52, and 58 in round figures, or 59 in round figures. Then we take out the income from redundant assets. There are some marketable securities in there. So we're taking out that to see what the normalized operating earnings are. Remember, we're going to see what the business is worth, not what its assets are worth. Its assets we can get from some other source. We can get the land evaluated by an independent real estate valuator. We can look and see what the marketable securities are worth on the stock market. What we're trying to do is see what the operations are worth, what we're prepared to pay for it. So we get these net incomes of which we've rounded here to 27,000, 40,000, 50,000, and 57, and taken out a normalized tax. Now, I'll talk a little bit about taxes in a minute, and Ontario's holiday and a few other things, but if you're projecting future, you look and see what the taxes are likely to be. And on this kind of earnings, the taxes, it'll qualify for the small business deduction, so you take that rate. So we've taken the tax rate of 25%, all right, to get after-tax normalized earnings. And in this particular example, I've said the 20,000 being the first year of operations really wasn't very representative, so I'm going to ignore that. And the 30,000, we seem to be at a figure there, 30,000. We jumped up $10,000 in that in 82. That's a bit of a jump, maybe 81 to 82. Maybe 81 was part of a year where the company still hadn't got properly underway. I think year-end valuation of earnings or year-end cutoff of earnings is artificial. Maybe the business cycle might be a bit longer, and businesses that are starting off generally take a little bit longer than a year to get started. So we're saying here maybe 18 months, maybe 6 months of 81 are not representative. So we'll cut that one out too, and taking as our representative earnings 1983 and 1982. Now we might come to the same result if we multiplied 83 by 4 and 82 by 3 and so on, weighted the averages. But I think that's a reasonable basis and for looking at what the representative earnings might be. Then on Val 17, we said, okay, the capitalization rate is either a 6 times or 4.5, and you find that these things follow quite a long time after interest rates. People will not believe when the interest rate is up at 20% that they shouldn't be getting at least an 8 times multiple. They just don't believe that. And then after a while, they find they can't sell their companies for that, and they'll go down to 4 times multiple. And then the 4 times multiples hangs around for a while because people don't think that interest rates are going to stay down where they are and so on. And that's what's happening at the moment. So I think a 6 times or a 4.5 times, somewhere in that range, they're reasonable. Now, whether you go to the bottom of that range or the top of that range will depend on other factors, and I'm going to talk about those factors in a minute. I've talked about them already, but I'm going to talk about them again. So if we take a 6 times multiple, then the high end of the range would be $240,000, and that's just for the operating of the business. So we say 40 is maintainable, 6 times 40 is 240. That is what the business is worth. But remember that we carved out 2 things. We carved out the fair market value of S Company Limited, which was purchased on December 31, 1983. In a previous example, that's when it was purchased. 1983. It was purchased on December 31, 1983, so its earnings are not contributory. We can assume that a reasonable valuation was done at that time and it was purchased at its fair market value. And then we take the net redundant assets, because that's what we could get for them. That's what we could convert into cash. We don't necessarily want to keep them. We don't like the land, especially where it's located, and we don't like the marketable securities. We'd like to be in something else. So what can we realize from those? 59,000. So that gives values of approximately 400,000 at the top end of the range, or 340,000 at the bottom end of the range. Okay? Now we would like to test and see whether those are reasonable values. We've only done one part of this little test here. Okay, what we have to do, though, before we do anything else, is we have to allocate that between the pref shares and the common shares. And remember, the pref shares come out first. They have first rights, normally speaking, to the underlying assets, and they were contributed for by Mum and Dad a little while before the end of the year. They have fair value of $90,000. That's what they're going to get. So that gives the on-block value of the common shares of 310 to 250, going from the top to the bottom. And that would give a rateable value per share, because there are 1,000 of them, at I get that right, whatever it is. Anyway, it's the rateable value per common share is 3,100 and 2,500 per share. Now, if you have a minority discount, maybe you can discount it by 10%, and that's all that's being done here, just an illustration of what might happen. We'll come back to whether you should have a control premium on that basis or not in a minute. Okay, so that's basically how we arrived at these figures of 310 down to 250. And the question is what is a reasonable value? From now on, I think I'll look at the value of the company rather than the value of the common shares, because we're going to be doing multiples of earnings, cash flow, and so on. So the figures to remember, the 340 to the 400, I think they're on most of the overheads anyway. Okay? Another method of determining what the value is, and this is becoming more and more popular as people realize that it's cash that buys groceries, is the capitalization of that cash flow. What is the cash flow that's going to be coming out of this company? I don't really care whether it's what the accountants say about this company, what the profit should be, because they're matching the revenues and the expenditures, and things that I think are proper expenses, they're deferring their deduction, and items that I've thought may have some value down the line, they've written off, and that's defrated the profits. I want to know what my cash flow is likely to be over the piece, and I want to capitalize that cash flow. So what you normally do is you determine that what's called the discretionary cash flow. The discretionary cash flow is really what you can afford to take out of the business without disrupting the business. Okay? You appreciate that if you have a building, it needs maintenance. Every now and then it'll need fixing up, a little bit more mortar here and there, doors and windows and so on. So you look and see what you can reasonably take out of that business, and that becomes the discretionary cash flow, because that's what it's worth to you. That's what you're going to be able to take out of the business. You select a capitalization rate, and you apply that capitalization rate to the cash flow that you've determined. And to this figure, to this cash flow, you add the redundant assets. Then you add what Lou described as the potential tax savings. It's really the tax shield. It's called we call it the tax shield. It's really the tax savings. I call it the tax shield, which is basically the advantage you'll get from claiming capital cost allowance. That's really what it is. It's what advantage, what savings in income taxes can you get from claiming capital cost allowances on your whatever you've got, okay? On your goodwill that you originally purchased in the first place. Remember, you purchased it before we're determining the cash flow. So you bought your building, you bought your automobiles, you bought all of those things. Now we're looking to see what the tax shield available on those fixed assets is. How much you can reduce your taxes because you can claim capital cost allowance. And there's a formula for doing it, and I don't intend to get into the formula. It's set out in the paper. It's just complicated to explain. It's also complicated to do. I did put a wrong figure in there in your written material, but I'll correct that in a minute. Your total cash flow is composed of your non-discretionary cash flow, these items I've been talking about, cash required to maintain the current operating levels and is not available for distribution. Just to go back and re-emphasize that point. Your discretionary cash flow, it's the amount that can be distributed without impairing the business. Now, that's always a bit of a judgment, but clearly when you see a company that is making, $1 million a year and has $40 million of marketable securities in it, you know darn well that it can distribute at that point at least $40 million. It doesn't need that in the corporation at that point. So those are the two components of cash flow, and we've got to decide in the future which portion you won't be able to take out to maintain the operations of the company. Now, having said I wasn't going to go through the formula, I'd just like to sort of try and explain in greater detail how we calculate the cash flow. What you look at is the net income before tax, so you might do that on a historical basis. You add the non-cash charges, because they don't require cash. Not now, they don't. Depreciation that you might have written on your books. You deduct income taxes. You deduct, these are taxes that you actually have to pay, and you deduct the non-discretionary cash flow net of related tax shield, which all that means is that if you realize you've got to put $2,000 into fixed assets each year, then you're going to get some tax savings from the fact that you've got that fixed asset because you can write it off. And that's all the net of related tax shield is. The tax shield is, you try and discount it. It's a continually reducing amount. It's the discounted future tax savings resulting from being able to claim capital cost allowance. You can claim it all in 1 year. It's fairly easy. The tax shield, and there's the formula. Please put the figures in. I just wanted to correct something in the material here, and it's on page 98. If you wouldn't mind looking at that, you'll see that where I've got class 10, the related tax shield is $2,200, which is basically the asset acquired, times 25%, which is the income tax rate that we're using, times 30%, which is the class. You write that class off at 30%. Underneath, however, I've got 14, which should be the required return rate. And my required return rate, which I've indicated on the previous page, is 19.4%. So as close as we can make it. That 14 should be 19. Just the way I write my 4s. I'm sorry I didn't pick it up. But anyway, that plus the capital cost allowance rate, and that's a sort of a formula for determining the that tax shield. Okay? Well, having gone through that, and there's that example there on page 98, if anybody wants to wade through it. And I'm going to wade through it anyway, even if you don't. The advantages of this capitalization is that it does use the cash flow, which is, I keep emphasizing, is what we all live off. It's what comes out, what we can buy goods with, what we can buy our tax shelters with, and so on. You don't worry about those issues related to deferred taxes, because deferred taxes aren't a cash flow. Deferred taxes, as Lou explained, are purely a mechanism to try and match revenue with expenses. That's what they are. And we have those deferred taxes because the theory is that if you save taxes now, because you claim capital cost allowance in excess of your depreciation rate, you're going to have to pay them later on. That's the theory. In fact, what you're probably going to do is buy some more depreciable assets with your non-discretionary cash flow. It does recognize, however, that what you do for tax purposes, like claim capital cost allowance, that's on a declining balance basis. All of those things you can do some on a straight line basis. So amortization of certain items is on a straight line basis, but most of it's on a declining balance basis. And it takes fast income tax write-offs into account. Looking again at the tax shield, your tax shield, if you had, looking at 98, if we take the top one again, the 2200, if you could write that off at 100%, then I think you'll appreciate that the figure that you're going to end up with is a fairly substantial amount as your tax shield. Okay, the disadvantage is that you're going to have to determine how much you're going to have to put back into the business. Now, lots of companies have become quite sophisticated in this kind of thing, but unfortunately they looked at 5 years projections, and then all hell broke loose in 80 and 81 with interest rates and everything else. They realized that 5-year projections were unrealistic. People were going back to 3-year projections. We did a 5-year plan, and the amount of money we put into that was awful, except that came at the time when we weren't very busy anyway, and probably we had to do it. But I think my personal view is that 5 years is a bit too long a range. I think we should be thinking more in terms of 3-year cycles. But that's one of the problems with this capitalization of cash flow. You're going to have to think outside the 3-year cycle as well. And you've still got to exercise your judgment, even when you've got the cash flow and you want to capitalize it at a certain rate. You've got to exercise that judgment as to what is appropriate. And once again, you're going to be looking at all the other criteria that you have to look at with the multiples of earnings approach. And what you can say, well, if I got to look at it anyway, I mean, why not do it this way over the multiple of earnings? And you might be right. Looking at the capitalization of cash flow, let's look at Val 22. We've decided that the net income before taxes is $53,005. This is just the formula that's set out on 98. We add back the depreciation and the amortization of $21,000. We take the tax thereon at 25%. All right? And we deduct the non-discretionary cash flow net of related tax shields. They're fairly small amounts. I'm not going to go through the calculation. So we can now say that our discretionary cash flow, the cash flow that this company generates that we can pay out in the form of dividends, extra bonuses, can invest, can pass up to a holding company, so on, is nearly $53,000. We capitalize that at 5.25%. Taking that as an example, 5.25%. or 5.25 times multiple, I'm sorry, at 19.4%. And that gives us a capitalization of the discretionary cash flow. It gives us a value of nearly 278,000. We've got to add back the tax shield because this is cash that is of real value to us, expenditures that we've paid that are of real value to us. It's stuff that sits there. We know we're going to get the tax savings on that. We add back the redundant assets, the same figure we had before, and the fair market value of ESCO, which is the company that was just purchased, and we assume we paid fair market value for it. And that will give a value of $442,000. Those of you who will remember will say, wait a minute, that's more than the $400,000 that you had before. So using this capitalization of cash flow, we have got to a larger number. At the moment, it was larger than the highest number we had, using a 6 times multiple on the earnings. Okay? I'll come and compare all of these in a minute. The next method is really discounting the cash flow. And it goes 2 ways. It says, first of all, we've got to be more careful in determining what our cash flow is. So it looks at the future earnings. It doesn't say these are our earnings we have at the moment, and we will do a multiple on those cash flow earnings, and inflation will take care of the discounting for us. This looks and says what really is going to be our future earnings, our real earnings in the future. So you have to forecast the future discretionary cash flows, the same concept of discretionary cash flows we had before. You deduct the additional capital expenditures net of tax shield to sustain a growth assumed in your forecasted earnings. So we're moving much more into a sort of a forecasting type thing, which is difficult to do, but much more realistic if you're looking to see what that company can do for you, and is really what high-tech companies do. And people who buy high-tech companies, that's what they're looking at. They see, what are we going to do in the future with this thing? What cash are we going to have? And then you present value all of that by applying an appropriate discount rate. While you can use this pretty well for anything, it is very usual to use it, it's common to use it in valuations of extractive industries like mines where they're going to run out, or gas wells. And it can also be used as a check on values reached under the capitalization of earnings approach. What are its advantages? As I mentioned, it's the most theoretically correct. It does use the cash flows, which is what we want. Anybody think there's an echo in here because I keep repeating some of this stuff? It recognizes that capital cost allowance is on a declining balance basis, and it takes fast income tax write-offs into account, and it dispenses with issues relating to deferred taxes. Most of the same stuff as we had before, but now we've got another problem. We've got to predict the future cash flows and what the residual value of the company might be.